episode 50. As you know, I'm going to show you the money, exactly how much I had in the beginning of the year, what I had at the end of the year, how much I contributed to my investments, what the S&P 500 returned, and then what my portfolio returned as well. And you know, I realized last time I didn't really do a trigger, and I wanted to bring this up. I showed this in the video last time, remember? And I've even shared with you previously that I think that all of us should have a really nice planner that we document all of our money thoughts. And in fact, you can see that I documented multiple things every single year within the back of the planner. So just to give you an example, this is usually where I would write things down, like how much money I started with, how much money I hope to put into the market, and then based on multiple rates of return, I would forecast how much I would have at the end of the year. I would take notes as I learned more about money. I think I may have shared with you guys previously that Vanguard, which is where I have a lot of my investments, manages my Roth IRA and my taxable account at this time. And what that means is they occasionally move the money into various mutual funds on my behalf. But one of the reasons why I hired them, and I'm paying assets under management of only less than a third of a percent, was because I have access to financial advisors that I can talk to about my money. And especially over 2019, which is when I hired them to manage those two accounts, is when I really started making appointments with the Vanguard advisors and talking through what is the reality of me retiring in 1, 2, or 3 years. So what you'll find as you get closer to retirement, which, by the way, for you guys, I know that's a long way off for most of you, but you will begin at some point in your life start thinking about no longer working. And sometimes it's advisable to speak with somebody, either as an hourly rate, a financial advisor, and or maybe having some of your assets under management. I've got mixed feelings about it myself. You guys know I'm not a financial advisor, so I just like talking about money and helping people figure out the basics of personal finance. I don't really, as you know, talk through what mutual funds you should have your money in, etc. But in 2019, I leveraged the fact that I could talk to the advisors and ask them questions. Now, I will also say that when I began my investing career, back in, and I say investing career in quotes, that just means my years that I was investing, I never really thought that I needed a financial advisor because, as I may have shared with you before, I truly believe that if you're putting your money in low-cost index funds that ride the market of the S&P 500 or whatever indice you may want to follow, that your results will be very similar based on what the S&P 500 does. Okay, so I wanted to share that with you because in 2019, I changed my thinking a little bit. I hired Vanguard again for those two accounts, So, more on that later, of course, but today I wanted to bring it up because, again, in 2019 was when I really started thinking about would I need a financial advisor or not, and that's the decision that I ultimately made. Now, for this episode, episode 49, again, I wanted to talk about how to think about the future success of your money. Now, just a little bit of information about 2019. Remember last time I said it was a phenomenal year, which I'll get into the details of the numbers in the next episode. But if you Google 2019, you'll see that fears were never really realized, that there were talks of a global economic slowdown, disruptive trade wars, and potential mishaps from Federal Reserve policy. I know, snooze fest. I don't really want this channel to become a place where I talk about what's going on in the world, etc., because personal finance is something that I want you all to know is so easy to figure out. It's the behaviors, as we talk about going onward, where we really get in trouble. But, I want you to know I was never really not only interested, but I didn't really make my decisions based on what was going on globally, etc. I just kept investing. I never looked back. I never sold my shares. I didn't time the market or anything like that. I just kept going. And so, but just to, give a little bit of information about 2019, there were some things going on that people really didn't think the market would do as well as it did. And I remember thinking at some point there had to be a downturn in the market. Now, of course, that happened in 2020. We'll talk about that next week. But in 2019, it just kept going up and up and up. Now, I know that what happens in the past, as I mentioned last time, doesn't guarantee that this will happen in the future. But one thing that's going to happen as you continue to save and invest, right? So let's say you're in your 20s right now, or maybe your 30s, and you're continuing to do what you do, which was, save and invest into these markets. You're going to buy and hold. That's what I like to do. Buy and hold, which just means you're buying the shares and you hold them. You don't take your money out of the market. You just buy and hold. Do you remember I talked about J.L. Collins? He wrote a book called The Simple Path to Wealth. You may want to take a look at it. He talks a lot about that as investors, it's better in most cases to buy and hold your investments long term. And 2019 for me really represented that really well, because think about it. I started investing in 2005, 2006, 2007, 2008. Market goes down. Then 2009, 10, 11, 12, 13, 14, 15, 16, 17. Remember 2018, it went down a little bit. And then we get to 2019. So that was a lot of shares that I bought in mutual funds. Are you following me? Because every time you put your money into an investment, you're buying shares. Those shares then are unrealized, meaning they may change in value based on market returns for the given day, but nothing really happens until you sell it. So there I was, clipping along. We get to 2019, and I have amassed a lot of money, which I'll talk about in the next episode. And included within that money, of course, are shares in very profitable companies that these mutual funds have within them, because remember, it's stocks that are within the mutual funds. And if you own X number of shares in, let's say, Apple or Google or Starbucks, then suddenly when we have a year like 2019, when those companies explode and the value goes up, well, then so does your portfolio, because you never sold the shares. Now, had you then, let's say, for example, what if you panicked in 2018? Remember I said last week that there was that dip and people probably panicked and like, oh no, the market's going down. What if they took all of their shares and sold them? Well, yes, they would have captured the amount of money and moved it perhaps into a money market account in cash. But that value went down, but then they lost the opportunity when it started to go up. Does that make sense? So you don't want to panic and sell ever. You want to be well diversified in mutual funds. You're going to be just fine. And then suddenly, this is how I want you to think again about the future success of the money. That engine, remember, that you're creating. That's what I want you to think of this as. You're clipping along all of these years and you're putting money into this engine. That engine in and of itself, while you're younger, doesn't mean much, really, does it? You're not selling the shares. You're not taking advantage of all of those opportunities where it went up or went down. You're just letting it sit there. And that engine all the while is creating the energy that it needs to then fuel, F-U-E-L. How do you spell fuel? F-U-E-L, yes. To fuel your future self. Because when you get that amount of money up to a certain dollar amount, remember you can take percentages off of your investments and maybe leave the principal of that money intact. That's how I want you to think. This is how I want you to think about the future success of your money. So just to anchor back a little bit to when I had mentioned in, I guess it was the episode yesterday, what if we have another 1982? That could happen, right? Remember I said where there were people that were probably in their 50s or 60s ready to retire. They'd amassed some money, and then boom, 1982 comes, and remember the portfolio, or I should say the S&P 500 went up 60%. Well, maybe they were well diversified. Their portfolio could have gone up 30%, right? Because if you have X amount of dollars and the S&P 500 goes up 60%, but in your X amount of dollars you're diversified into 50% stocks, 50% bonds, you're not going to get